investing can be easy or is almost like a solved problem nowadays, but financial planning can be hard. That's certainly something that I learned in the last 2 days. It feels like their life goal was to, to bring all those learnings and insights from these Nobel Prize winners in finance. But they felt like all these contributions weren't properly ported over into practice. And so they take all that research and they codify it. They take all the math from these slides, they codify it, they put it into software, they put it in an Excel file, and you can use it for free. I'm impressed that they were able to model all these things. I didn't think you could model this, to be honest. All right, let's go. All right, thanks for joining, Mark, Terry, Edward. I think first time, right? You guys, all of you. But yeah, great to have you here. So today is really about financial planning. And I really went down a rabbit hole because, as so often, I was inspired by Ben Felix, who has a great YouTube channel.
Yeah, he does.
Right. Yeah. I found him like a year ago, and I really enjoy his videos. And so we already in past meetups we already had the insights that investing in a way is almost like a solved problem. It's there's so much evidence pointing to indexing and index investing and how that is superior in many ways to stock picking or trying to time the market. And but we already had the insight, and we also asked ourselves in past meetups, what's the value of a financial advisor? What do they bring to the table? And then, yeah, we realized investing can be easy or is almost like a solved problem nowadays, but financial planning can be hard. That's certainly something that I learned in the last 2 days. I sent out this invite on Wednesday, and in the meantime, I researched this topic, and it's a huge rabbit hole. So yeah, in this video, they interview Paul Kaplan, who we'll see below. He worked for Morningstar. He has all his life. He did a PhD. He worked in finance. Just huge track record, really impressive. And I watched a lot of YouTube videos from both him and also from Thomas. I'm not sure how to pronounce that name. Idzorek, I guess. I watched a lot of YouTube videos from both, and yeah, they clearly know their domain. It's pretty impressive, and I feel like their life's goal was to, and we'll see that below. Let me scroll down. It feels like their life's goal was to bring all those learnings and insights from these Nobel Prize winners in finance. All these insights that were connected somehow to lifecycle-finance, how they call it. But they felt like all these contributions weren't properly ported over into practice. Financial advisors did not really apply them. The financial planners did not really apply them. And so they wanted to do that. And having spent 2 days going through their material, you know how when you go down a rabbit hole, you feel like you know less at the end of the after the 2 days than at the beginning. That's how I feel right now, because they just threw up so many questions in the last 2 days where I researched them. But I feel like that has been their motivation all their career to port those contributions from these Nobel laureates over to life cycle finance, to personal finance, to financial advice, to financial planning. Hi, Miroslav. Nice to meet you. Good to have you here. as well. All right. So I already talked a little bit about their motivation. Yeah, by the way, I'm just gonna talk for, I guess, like 15, 20 minutes max, and then I'll be curious to hear your thoughts as well. And so, yeah, they found financial advice is often fragmented and often too focused on investment and not enough on consumption. Like financial advice rarely is normative in the sense that it gives you advice on how you should spend your money, how much you should consume, if you should buy insurance, if you should buy annuities and hedge future consumptions in the case you grow very old. Finance usually doesn't answer those questions. It only answers the questions how you should invest. And they really wanted to fill that gap. Yeah. And how do they do that? They try to do that with a holistic approach. So they really look at they include something what they call human capital, which is the sum of your future earnings, the discounted value of all your future earnings, and also your liabilities. They kind of create a balance sheet for a person, which is a nice idea. I never thought of that. So they do that. They create a balance sheet for a person, and they include that in the asset allocation. And so if your human capital is very, they say like bond-like or stock-like, uh, if you have a very stable income, if you're like a university professor, if your income is not correlated at all with the stock market, then your human capital is very bond-like, and that will have an impact on your ability to take more risk. And so that's their approach. They try to create this holistic approach when it comes to, yeah, life cycle finance, not just investing, but also the whole spectrum, including consumption, insurance, and so on. Yeah, and it's crazy. They publish all of this for free in a book, and they even publish an Excel file where you you can open it and play around and put in your own values and see what their model recommends for your particular situation. And basically that model answers the question how a rational person would behave, should behave. Like how would a rational person, how much would they consume? We can see it here. How much would they save each year, given your circumstances, given your age? We'll look at the inputs of the models in a second. How much would they consume? How risky would they invest? Would they buy any insurance? Would they buy any annuities? They they seem to be huge proponents of annuities. Like I worked at an insurance company before, and I personally didn't think very highly of insurance products when it comes to investing, but they really changed my mind. So apparently there's there are a lot of use cases where a rational person would buy an annuity. Like if you think you have a long life expectancy, and if you want to hedge your consumption, you want to hedge the risk of running out of money, then it's very rational to buy an annuity. And also inheritance. Yeah, they even answer. They collect your preferences on how much do you want to leave behind. They call it bequest. I didn't know that word before. But yeah, they also, their model takes that into account as well. Like how much. I mean, the entire point of saving is past consumption or to leave for legacy and inheritance, and their model answers that question as well. So they call it like a 3-part model, like the life cycle model, top model. They collect income, education, age, risk tolerance, and other preferences. And then they create this economic balance sheet, which we'll look at in a moment. And they'll translate it into an asset allocation and even into asset location. So for example, if you have tax advantaged accounts, taxable accounts, their model takes everything into account and tells you what a rational person would do, even trading cost. Their model tells you if your asset allocation is, I don't know, like 60-40 stocks and bonds, like how you should spread that among all these different account types. Yeah, and these are basically the outputs of the model that you see below. So how much you should spend and save and leave behind as inheritance. If you should get life insurance, annuities. Even you can even put in your ESG preferences, so or your values or your faith-based preferences. So and then it would take that into account as well, and it will make it tax efficient. And you can even do tax loss harvesting, which is a concept that we actually don't have in Switzerland because we don't pay capital gains tax because we have a wealth tax. So I'm not familiar at all with tax loss harvesting, but the model takes that into account as well. All right, yeah, as you can see, I'm pretty blown away and overwhelmed after 2 days of looking at this. And these are just some of the questions that they try to answer. Like, should you roll over your 401k portfolio into an IRA, which are US systems, which I'm not very familiar with, but I know that they have different tax rules, of course. Decisions between active and passive, decisions about rebalancing. And I didn't, honestly, like going into all of this, I didn't think there would be rational, like normative rules for these and answers for these questions. I thought these questions would be more or less, I don't know, like it's almost an art. But they really tried to answer all of these questions quantitatively and answering how a rational person would do that. Yeah, and that's really it. It's a theory of rational decision making. And Paul Kaplan, he really dedicated his whole life to this. And here's the PDF. It's 250 pages. It's accessible under this link. I can send you these notes if you're interested after the call, so you can look at this link and look at the PDF. Yes. And they also and they also published this an 8-part video series going through the chapters, going through the book, which was fascinating. I studied accounting and finance, and I could barely follow this. So it's pretty. Yeah, I will. Yeah, I'll send it out. I see the comments in the chat. I could barely follow this. So you'll see below. It's crazy. Like for example, Markowitz, I can somewhat follow the Markowitz equations to how to optimize a portfolio and how to minimize volatility for a portfolio, how to optimize weights. I understand that, but they take that and they add utility theory and how to maximize utility and how much a person should consume, and they just keep going and going and going, and it just stacks up. It feels like a PhD, to be honest. Like this 8-part series, I've never seen anything like it. I wonder how a university would treat this. I don't know if you could teach this in one course or if it's too much. I personally think it's too much. All right, and this is their holistic approach, where they look over an investor through their whole life while they accumulate wealth, and after retirement when they start decumulating. And at the beginning of their life, they have a lot of human capital, which is the green area. And then as they work, they turn all of that human capital into financial capital. So they start saving. And the total wealth is the combination of these two, the combination of the human capital and the financial capital. And then, they model out to, in this case, to 105 years, which is well beyond any normal life expectation. And they model your wealth and your consumption and your savings and everything. And also a lot of people choose to buy life insurance early in their life to hedge against the risk of dying in case you have people depending on your income and depending on your human capital. And then towards the end of your life, you might want to hedge your consumption and insure against the risk of running out of money. And that's when you might want to buy an annuity. So they also include that in this chart. I already mentioned this. They really ported these contributions from Milton Friedman, Markowitz, William Sharp, and I didn't really know the others, but they're also Nobel Prize laureates, into their work of lifecycle finance. And here we see their holistic profile of an investor. They create this balance sheet here on the right, like an individual balance sheet. So an investor, we see this here in more detail. So an investor has assets. We have bank accounts, of course, but we also have this human capital, which is our ability for future earnings. And we have liabilities, which is our future consumption. It's a bit abstract, but I guess it makes sense. So all your future consumption, everything that you, especially the non-discretionary, so everything you have to consume. So the rent you have to pay in the future, the healthcare bills you have to pay, all the non-discretionary consumption, that's a liability in your current balance sheet. And the difference, if you take all the assets and you just subtract the liabilities, you get the net worth. But yeah, so they take this holistic approach to an individual, and they also look at your consumption preferences. How much do you discount? Like, what's your preference for consuming some right now and in the future? There might be different preferences. Like how smooth do you want your consumption to be? Are you okay with going it up and down and fluctuating it with the stock market, for example? Are you okay with that, or not? Do you want smooth consumption every year? Do you have a lot of fixed costs, for example? Then you probably need a lot of smooth consumption. What are your preferences regarding bequest and inheritance, leaving something behind? What's your risk preference? And also, they distinguish risk tolerance and risk capacity. So risk tolerance would be, like, do you mind if the value of your wealth goes up and down? And the risk capacity would be, do you actually have the capacity, or are your fixed costs too high, regardless of your tolerance? Like, so they distinguish that as well. And then they even take inputs such as about your faith, your values, your ESG preferences. And they take all of those preferences and then they try to answer those questions, like how much you should spend and how you should invest, how your asset allocation should be, and so on. Or what a rational person would do, at least, given your inputs. And obviously, collecting those inputs is a challenge. They also say they are not experts in profiling. They're not experts in collecting those inputs, but they hope that other people will create tools for determining your risk tolerance, for example. There's many different ways to approximate that value. We all have one. We all have a risk tolerance. So yeah, but once you have the inputs, then you can use their Excel file. And now I think I'm just going to jump over most of these slides because now they go into the weeds of how it works. And honestly, I don't fully understand it in those 2 days. But it's interesting how, for example, here how they place their work within the other contributions such as Markowitz and expected utility theory and life cycle theory. Yeah. So yeah, I'm pretty shocked, to be honest. All right, I'm just gonna jump down to the Excel file, to the actual tool. All right, so here's the tool, and so they take all that research and they codify it. They take all the math from these slides, they codify it, they put it into software, they put it in an Excel file, and you can use it for free. And it's also a call to the industry to kind of adopt this. They think financial planning and financial advice, should orient themselves more to these contributions, right, from those Nobel laureates, and so it's also a call to the industry to adopt their tool. So that's why they published it. They wanna make a contribution and hopefully change the industry of financial advice. And here I put in the example of a 35-year-old male that has no children, and I put in the assumption that his human capital is pretty bond-like, meaning he has a pretty stable job and his income does not fluctuate with the stock market. And we can look we'll look in the inputs right now, like below, and in more detail. But what's already interesting is you can see what the model tells him what a rational person would consume, like given his inputs, how much would a rational person that maximizes utility consume, how their financial wealth would behave over the following years and after retirement, how their human capital would decrease over the years, and how their net worth would behave as well. And there's different probabilities. So there's the median expected, and then there's different percentiles. So there's a 1 in 20 chance that you can consume, in this case, 40. Yeah, there's a 1 in 20 chance that you can consume this much, and that your financial wealth will be 5 million, I guess. All right. So looking at the inputs, yeah, I in this example I took a male, 35. They have a expected lifespan in the model, but you can adjust that. So if you think you're healthier than the average, then you can put that into the model and say, all right, I think I'll live 3 years more than the average. You can also say how long the model should model all the values. Should you model 200 years into the future or less? So you can put that value in as well. Your consumption preferences regarding consuming today or tomorrow, smoothness preferences, how smooth you want to consume, risk tolerance, how high is your non-discretionary consumption, what are your fixed costs. Sorry, I just saw a question in the chat. How do they model the case where one gets Alzheimer's disease and needs extended care for the last 10 years of their life? That's a good question. In case you have a lot of cost towards the end of your life, a lot of healthcare cost, I guess that's just part of consumption, right? And and hopefully it's insured, right? Like hopefully we all have health insurance, and in case you need this extended care, it's covered by insurance, hopefully. But if not, then you're right. I think consumption should go up towards the end of their life. And this is just what a rational person would do. But that's a great point. I didn't see a parameter where it would pick where it would allow you to increase consumption towards the end of your life because you think you're gonna have healthcare cost. Yeah, the financial wealth. So I think what the years that you see here below is years into the future. So this is a 35-year-old male. So this is 70 years into the future. So by that time, this male will be 105 years old. Yeah. Yeah. So by that time, the wealth will approach zero. Yeah. All right. And then I put in just some example values. I put in the person has some domestic stocks, some global stocks, no bonds, just a bit of cash, total financial wealth of $450K US dollars. I put in the person wants to retire at 65, has a salary of 100K. Included in those 100K are contributions of 15K to, I guess pension fund with a 50% employer match. The person has a college education. The person doesn't want to annuitize their consumption later in life. The person doesn't want to leave an inheritance. And like I said, the income is pretty bond-like, so pretty stable, not tied to the stock market. And the output were different balance sheets. Let me just read the comment. Are income, wealth, value-added, sales taxes incorporated into model? Yeah, income definitely, wealth as well, taxes as well. I'm not sure about sales taxes, and I'm not sure about what you mean by value-added. But yeah, I'm pretty impressed by what they account for, everything they consider. All right. So in this example, so we have a person here with a pretty stable income and a high risk tolerance. And I expected an allocation, therefore, to be high in stocks. And that was also the output. So I was happy to see that. The person already had 450,000 financial assets, which were already 88% stocks. And the model, and the model told it to go 20% in domestic stocks and 80% into global ex-US stocks. And in addition to, like, usually when you look at a person or when a financial planner looks at a person, they usually only consider this financial wealth. But in this case, they also look at this human capital, which is the future earnings of this person, which I said is pretty bond-like in this example. And that's why this person is able to take risk, because their human capital is so bond-like, and that's how we get to this asset allocation of 20% domestic stocks and 80% global stocks. Yeah, here's a summary again of these three balance sheets. We saw three balance sheets. They show the current asset allocation, an unconstrained version, which assumes you can go long and short. You can go short bonds, and then a constrained version, which just says you have 450K to invest, and let's just allocate that, and let's not go into that additionally. All right, and then I wanted to see how does it all change if you change the human capital from one person and make it less bond-like, make it more equity-like. And that's what I did here. So the only thing that's different here is there's this one value, human capital, overall equity exposure. I bumped that from 20 to 80%. Otherwise, it's the same person. And then in the output, what we see is here. So now the allocation changes because the human capital is so tied to the stock market. The output of the model tells you to take less risk to invest your financial assets more into bonds because your human capital is already so stock-like. Yeah, so this is just one example how their model takes into account more than what a traditional financial planner might do. But yeah, I'm curious to hear your thoughts afterwards. But I think it's not very intuitive. It's pretty it's complex, and I'm not sure how easy it is to determine your human capital. Like I would assume most of us would say our income is pretty stable. So most of us will probably say we have a bond like human capital. Yeah, the inputs are also not so easy, not so straightforward to determine, in my opinion. All right, and then I put in a retiree. I put in a 65-year-old person. Here we go. Let's look at the 65-year-old person. Different wealth numbers. 60K non-discretionary consumption, for 450,000 domestic stocks, about 1 million of financial wealth. And in this example, I also put in, this is a person that does not buy an annuity. So they don't hedge their future consumption against the risk of living too long. And they also don't intend to leave a legacy to any inheritance. And yeah, but here they model how consumption looks like, future consumption for that person. The financial wealth, obviously they're consuming wealth. The human capital and the net worth. And let me see. Yeah, I was looking for this. So bottom line, so the person is currently 68% in stocks, and the model only recommends for this retiree only 28.9% in stocks, 42% in bonds. And why? Because the retiree has a retirement income, like Social Security, which is a bond-like asset. The retiree also has non-discretionary consumption, which they have to pay, so a fixed cost, which acts like a liability, a bond-like liability. No inheritance. It calculates a net worth. I put in a risk tolerance of 50%. And after all of that, with those inputs, we got this allocation of 13% domestic stocks. Yeah, 28% stocks, 42% bonds. Yeah. It was just interesting to see for a retiree how the model would shift a little bit into bonds, which is also common advice that you hear nowadays, right? Like if as you get older, as you maybe want to reduce volatility in your portfolio, and in this case, because the person has a lot of non-discretionary future consumption that they have to fund, they reduce the allocation to stocks and instead move it into bonds. And here's the whole math behind it. And honestly, I would have to study this in more detail. And all right, just last example. I'm sorry, this is longer than what I said. This is longer than 15-20 minutes. But this is my last example. I just took the same retiree and I said, all right, this is an individual that wants to annuitize, that wants to hedge future consumption. And I wanted to see how this changes the model. And it allows this person to consume more. And again, this is what a rational person would do. So, and it also changes the allocation to 35% stocks, 20% bonds, 35% cash. All right, I think that's it. As you can see, it's I think I only scratched the surface. I didn't even go into asset location, like where, like how should you spread this between your normal savings account, your brokerage, your retirement accounts. Yeah, we didn't even talk about asset location, and we didn't talk about taxes. We didn't talk about rebalancing, and I'm impressed that they were able to model all these things. I didn't think there would be. I didn't think you could model this, to be honest. So yeah, all right. I'm gonna stop the recording right here.